You know, every single time you stream a video or send a text, you're essentially a tenant on an invisible highway. And today we're going to talk about the company that owns that highway, the world's digital landlord, American Tower.
So you see these huge tech shifts happening, right? Like 5G, it's everywhere. And as an investor, you're probably thinking, how do I get a piece of that action? Without betting on some fad that's hot today and gone tomorrow.
Well, here's the core idea behind this investment, and it's actually pretty elegant. You don't try to pick the winning phone. Instead, you buy the landlord. Forget trying to guess which carrier or handset maker is going to come out on top. The play here is to own the essential, irreplaceable real estate that all of those companies have to rent. All right, so let's dig in. First up, the bull case. What's all the excitement about? What makes American Tower's business model such a powerful engine for growth? Okay, so at its heart, American Tower is what's called a REIT, a real estate investment trust. Just think of them as a landlord. But instead of renting out office space, they're renting out space on cell towers. All the big carriers, AT&T, Verizon, you name it, they pay American Tower rent to stick their antennas up there. And here's the absolute best part. Those contracts are long-term and non-cancelable. That means predictable, recurring cash flow, month after month, year after year. For an investor, that's a beautiful thing. And this is where the business model gets really, really sweet. Getting that first tenant on a brand new tower, yeah, that's the expensive part. But adding a second tenant or a third, that's called co-location. And it costs them practically nothing. It is almost pure high-margin profit. Same deal when an existing tenant needs to upgrade their gear for 5G, that's just more high-margin revenue. It's an incredible operating leverage story.
Check out this number, 98 to 99%. That is their typical lease renewal rate. Just think about that. Almost nobody ever leaves. And why would they? It's a total operational nightmare for a carrier to move their critical equipment. It's expensive, it's disruptive, it's just not going to happen. These towers aren't just important, they are absolutely mission critical.
So, what's American Tower's big competitive advantage? Its moat? It's just sheer massive scale. Look at this chart. They absolutely dwarf their main competitors with their global portfolio. And this scale isn't just for bragging rights. It gives them huge negotiating power with carriers and, maybe more importantly, a foothold in faster-growing international markets.
And that global footprint, well, it represents a really fundamental strategic choice. It's the key difference between them and their big rival Crown Castle. See, Crown Castle is a US-only pure play. It's stable, for sure, but it's a mature market. American Tower is making a totally different bet. They're going for higher growth overseas, and they're betting on the future convergence of technology with their data center business. Speaking of that bet, let's talk about their acquisition of CoreSite. This is their wager on the future of something called edge computing. The idea is pretty simple. You want to bring data processing physically closer to the user. So if their towers are the far edge for your phone, these data centers are the metro edge for an entire city. This whole setup positions them perfectly for future technologies that need super fast connections, like AI and autonomous driving.
Okay, so that's the bull case, and it's a strong one. But it is not the whole story. Every investment has risks, and for American Tower, the big storm clouds on the horizon are all about macroeconomics.
Let's start with the debt. This number, 5.1x, is their net leverage ratio. So what does that actually mean? Well, to put it simply, for every dollar of profit they earn in a year, they're carrying over $5 in debt. Now, in a world with 0% interest rates, that's manageable. But in the world we live in now, with higher rates, that debt gets expensive really fast. Remember that awesome global strategy we were just talking about? Well, here's the flip side of that coin. A huge portion of their revenue comes from overseas. So when the US dollar is strong and they have to convert all those foreign currencies back into dollars for their earnings reports, poof, a lot of that value can just vanish into thin air. And believe me, this isn't some tiny theoretical risk. We're talking about a massive impact. In just one single quarter recently, this foreign currency effect wiped out nearly $500 million from their earnings. $484 million gone. That's a real material hit that adds a ton of volatility. Here's another key risk you have to be aware of: customer concentration. So while it's true that tenants rarely leave, look at this chart. Just 4 massive companies account for 60% of their revenue. That gives those carriers a ton of bargaining power when it comes time to negotiate big future deals. And finally, the whole industry is facing a bit of a headwind. You could say the gold rush phase with the 5G build-out is pretty much over. Carriers spent a fortune getting their initial networks running, and now they're pulling back on spending. That slowdown directly impacts American Tower's growth in the near term. It's as simple as that.
All right, so we've seen the bull case, this durable growth engine, and we've seen the bear case, these significant headwinds. So what's an investor to do? How do you weigh these two opposing forces? Let's try to put it all together.
This side-by-side comparison is great because it really highlights the strategic differences. Just look at AMT's massive international site count versus, well, 0 for Crown Castle. Also, check out the net leverage ratios. AMT sits at 5.1x, which is substantial for sure, but it's actually lower than its peer SBA Communications at 6.5x. So it's all relative.
Now let's talk about the price. How is the market actually valuing these companies right now? For REITs, the key metric is price to AFFO. Now, AFFO is just a fancy term for a REIT's actual cash flow. And as you can see, all three of these companies are trading at multiples well below their 5-year averages. The market is clearly reflecting the impact of higher interest rates on the whole sector.
And this quote right here, it just says it all. The entire investment decision boils down to this balance. Do you believe the growth potential from their global scale and their data center strategy is worth the added risks? Is it worth the foreign currency swings, the geopolitical uncertainty, and the higher complexity? That's the trade-off. So if you're watching this company, here's your dashboard. These are the key things to monitor. You have to watch the health of the core U.S. business, keep an eye on new leasing applications, track the performance of that CoreSite bet, listen to what the carriers say about their future spending, and of course, keep a close eye on that debt level. Ultimately, it all comes down to this one single question. Is the company's complex, ambitious global strategy a brilliant move that's going to unlock decades of growth, or is it just an introduction of unnecessary risks that will weigh on returns? That is the question every potential investor has to answer for themselves.